2 or 3 days ago, as it touched the $35 level precisely, within seconds, I'd got a message out on LinkedIn to all my followers. I got about 15,000 followers saying silver has just broken the $35 level a few seconds ago, and this is the level that everybody has been watching because we've all been waiting for it to break $35. And when it does break $35, psychologically, everybody's turning bullish and buying it above the $35 level. And I wrote that about half an hour later, when it was at $35.50, I wrote it could get to $36 pretty quickly. And I think we did that the same day, if not the following day. And now we're pushing on $37. I'm seeing on the futures $37.01. I imagine it's slightly below that on the spot market. So yes, Stuart, what do I think is going to happen? I think we're in new territory. I think it will go a lot higher. I've been talking about the supply deficit of silver, where less silver has been mined for several years than is being used in industrial uses. The biggest increase of use in silver is from the electrical industry, where consumption of silver continues to rise rapidly because components in electricity are getting smaller and smaller. So that doesn't actually mean you need less silver. It actually means you need more silver, because the smaller the component, the more reliable you need the electricity conduction to be. And so silver is going into more and more products, micro products, to ensure that they're reliable. And in some cases they're putting gold, but that's another story. That's not affecting the gold price. So we're in a situation where that deficit of silver globally is set to continue rising as mine production continues falling, consumption continues rising, widening the deficit, and that difference has to be met from recycling. So whenever silver has a spike, the recyclers will always come out of the woodwork. People with coin collections, bar collections, silver candlesticks, they will turn up and they will try and sell some, but usually there's a bit of a lag. So I think we probably do continue a little bit higher for a few days before we get to a pause. Will we touch $40? I think there's probably about 30% chance that we could do it in the next couple of weeks. Well, whilst we've seen record central bank buying last year and also at the start of this year, we saw yesterday, as China brought out its numbers, that they've been cutting back on their gold purchases. I think it's the number of ounces they bought in the last 3 months has gone down from 160,000 to 90,000. Then I think it was 70,000. I think the latest one is 60,000 this month, in the month of May. Now, it could be that they're just showing price sensitivity. It is at an all-time high as far as the Chinese are concerned. Or it could be that they are buying a lot and only telling us about a little bit they're buying to kind of store some silver under the table so as not to spook store some gold under the table so as not to spook the gold market, so they can keep acquiring gold. If we do have another type of Bretton Woods agreement forced on us by some sort of currency meltdown, distrust of the currency, then whoever's got the most gold will be calling the shots. And you kind of want to have something in reserve which you're not telling everybody about. So it could be that China's secretly acquiring gold, which we don't, I can't say they are or not. There's a lot of speculation they are. But right now, with the official number showing they're buying less gold, that's obviously making the market sit back and say, well, perhaps they're not going to buy any more, or maybe they'll buy less. But I think gold remains well supported, nevertheless. The delivery notices in them, I haven't got the latest numbers for June because I haven't looked at it yet, but the delivery months in the months of January, February, March, April and May for gold and silver actually were massively ahead of the same months in the previous year. In fact, by mid-May, the number was 700% above mid-May, or not the whole of May, for the previous year. So that was the 100-ounce bars of gold, which are, if you like, $350,000 or $330,000 each. So somebody is taking huge deliveries of 100-ounce bars, which was never, that sort of level of delivery was never seen before, because traditionally COMEX was a futures market where people would get to the spot month and they'd roll their spot month into the future, whether they were long or short. For those institutions which were short, such as bullion banks and so forth, the way they would play the game would be to own spot gold, and sell it 3 months forward or 1 month forward, where you get a premium price, and then because they've got the gold at the spot level, as the gold they've sold on a forward basis reaches the spot month, they then resell it for 3 months forward, continuing collecting what's called the contango. The contango is the difference between the spot price and the future price. The future price generally trading at a premium to the spot. So that was the kind of market it was. But something changed this year, from about January this year, when people started to take, instead of rolling their contracts forward, they were taking delivery of that gold and removing it from the exchange. Why were they doing that? Was it that somewhere in the shadows there's a major buyer? And if so, who is it? We don't know. I mean, there's lots of speculation as to who it could be. And I can throw a few names around just saying it's speculation, but there is no plausible rumor as to who it could be. But it could be a foreign government who's acquiring gold because they don't have enough, or let's say Mexico or China, for example. Well, probably not China, because China would buy through London, I think, but let's say Mexico or Canada. Maybe it's Berkshire Hathaway. I think that despite what everyone thinks that Warren Buffett thinks about gold, he does come from a background with his family, his parents' family, who were sort of very much in favor of gold and very much against America going off the gold standard. And of course, Warren Buffett has had his forays into silver. Now he's retired and there's a new guy in charge, so we don't know that. But obviously, he could have been a big buyer of gold. Then who else could it be? Well, it could be some people have mooted that it might be the US government itself acquiring gold, because perhaps the US is going to go back onto a gold-backed dollar. Obviously, it can't be a gold-backed dollar at the present price. It would have to be a gold-backed dollar at a much higher. The price, the historical price was $42 that. It can't go back on $42 that, but it could go back at $3,500 or $4,000. But that doesn't mean to say it would go back onto a gold standard where everybody can turn in their dollars and get gold. They wouldn't have enough. So what would they have to do if they go back onto a gold standard? They'd have to go back onto a gold standard with a gold-backed dollar, whereby the ability to convert your existing dollars into gold-backed dollars is severely restricted. You might be able to convert $500 worth or $1,000 worth or $10,000 worth, but there's no way you could convert all the dollars which exist into a gold-backed dollar, because it just isn't enough gold. But obviously, if they got more gold, it would mean that everybody could convert a little bit more old dollars to new dollars, and that would be some sort of currency reset. If they did that, of course, it would solve the national debt problem, because the debt would be left behind in a currency which is no longer allowed to be used in the economy, because they'd be forcing people to pay their taxes in gold-backed dollars, or shopping in gold-backed dollars, and everything else. Now, I'm not saying that's going to happen. It's just a speculative theory. I mean, it could be we might get another currency in the form of central bank digital currencies. We might get ration coupons. That's a kind of another currency as well. We don't know what's coming, but at the end of the day, the fiat system that we're in today, where governments are piling debt upon debt, cannot continue indefinitely, and at some point, buyers are going to get indigestion, and it will. Then we have to see what happens. I mean, there's lots of theories about what happens next, and none of them are good for the holders of debt. None of them are good for holders of fiat. This is the consensus that they've thrown all austerity measures out of the window, and now it's spend, 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 as if they won the lottery, which obviously means the debt will go out of control faster than would have happened otherwise. But you only have to look, before all this happened, just look at if anyone has the time, go to the Congressional Budget Office's numbers, and the latest forecast you'll see, the official forecast that they do for the budget going forward for the next 10 years, is from January 2025. So in January 2025, they made their forecast for the next 10 years, and this shows the debt to GDP ratio rising. What that means is the national debt will rise at a faster pace than the gross domestic product, or faster than the economy. So it's a bit like a family, your salary is rising by 1 or 2% a year, but your credit card debt is rising by 10 or 20% a year. It's just getting bigger and bigger. And there comes a point where it becomes completely unsustainable. So when you look at the CBO's forecast as it was in January, it showed the debt to GDP ratio rising from, let's call it for simplicity, 100% to 150%. I mean, those aren't precise numbers, but it's a huge rise over the next 10 plus years. And a number of the numbers they've got in there are fairly conservative. When I say conservative, that they're conservative in terms of this is the best case scenario. They expect there should be no recessions, no natural disasters, no wars, no pandemics, no crises, no unemployment, rise in unemployment. Nothing. There's going to be nothing which will tilt the figures negatively. So if we would have, for example, another pandemic, of course, tax receipts will go down and spending will have to go up. If there's a natural disaster, same thing. If there's a war, same thing. So the assumption is there'll be none of those. And the other assumption which is being made, which I find rather adventurous, is the assumption that the interest rates that the government will pay on its national debt will be about 2.8%, rising to about 3.3% in a decade. Yet the cheapest interest rate you could get as a government now, the US government, is about 4.4%. So if you factor in these higher interest rates, that debt to GDP ratio accelerates at a faster rate than the government's was predicting in January. And of course, they have said if this tax bill goes through, they'll have to revise the figures again, and it's going to add, and I've done the maths on this, it's going to add really $500 billion a year to the deficit, which should this year, which ends in September, this is the fiscal year, should be 2.1 trillion this fiscal year. That's going to go up to 2.6 trillion deficit. What does that mean? It means the debt gets bigger by 2.6 trillion. How much is that as a percentage? Well, if you take the debt at 36 trillion, I think that some of that's debt owed by the government to itself and internally. If you take it 30 trillion, it goes up by 2 point something trillion. Well, that's about 7-8% increase in the debt in the year. Now, the economy isn't growing that fast. The economy is growing by 1 or 2%. If at all. Japan has the advantage that most of its debt is owned domestically, and most of it is owned by the BOJ, the Bank of Japan. And the Bank of Japan, through its ongoing purchases of government bonds up until a few months ago, and everything changed a few months ago, up until a few months ago, was keeping the interest rate on all these government bonds at something like 0.1, 0.2%. Now, suddenly they've, over the last year or so, they've let it go a little bit. And on the 30-year bond, the interest rate is now over 2.5%. But it's still, although they have double the debt, they have half the interest rate, if you see what I mean. But it's going to turn into a problem for Japan now that the interest rate was, let's call it less than 0.5% for Japan for decades, and suddenly it's gone up. But when they were paying that little interest on double the debt, it's not the same thing as the US government paying what they call 2.8%, but will very soon be 4 point something percent. On half the debt, they're paying twice. The USA is paying 4 times as much interest. So I know that people do this comparison with Japan and America, say Japan survived. Yes, they have. But how did they survive? By the BOJ buying the bonds. Now, what could happen in America is that we might get the Federal Reserve stepping in when interest rates start to go beyond a certain point. And when the Federal Reserve steps in, they will have to print money to buy those bonds. There's nowhere else the Federal Reserve can get the money to buy government bonds. So the liability side of the Federal Reserve's balance sheet is the money they printed, the electronic money, and the asset side is the bonds they bought. So when they're invited to or persuaded to, or they just happen to think it's a good idea all by themselves, to buy government bonds to stop the rate rising, that's when they start printing and buying government bonds. And that's what they did in the 2008 financial crisis, and miraculously it happened without any great impact on the rate of inflation. They did it again during the COVID pandemic. And again, it looks like there was no impact on the rate of inflation, except there was for those people who are planning to spend money in their retirement. Because those people who want to spend money in their retirement and saving for their retirement, the things they need to buy in their retirement have been rising much faster in price than the CPI. And I'm talking about things like nursing home care, things like a nice home with a snooty drive, or a centre of town apartment near to the shops. I'm talking about the school fees for the grandchildren, just about the lovely things, the paintings on your wall, the nice things to have, which are in limited supply. Those are the things which are rising in price. And of course, the other area, or the main area where all this surplus money has gone, has not been into the consumer price index, which has been suppressed by the fact that most things you buy are made by robots, not by humans. So the rising labor cost isn't hitting your prices very much. Most of what that money, which has been borrowed by the government and spent, has ended up finding its way into asset prices, home prices, equity prices, Bitcoin, gold, silver, now platinum maybe, and other assets, like if you go to some of the auction sales and see the price of a rare painting by Leonardo da Vinci or something, I'm sure these things would be going for hundreds of millions of dollars, because there's only one of them, and there's going to be at least two people with that much money who want it.
If Clive Thompson is right, we're standing at the edge of a historic financial shift. The question is, will you be holding paper or something real when the reset begins? Don't wait until it's too late. Like, share, subscribe, and hit the bell icon for more urgent updates on gold, silver, and the future of money. Stay informed. Stay prepared.